Dear friends, welcome to the June edition of Monthly Viewpoints. The month of May was all about discussion and increase in oil prices due to US pulling out of the Iran deal. Oil prices briefly touched $80 per barrel mark, and when you look at since early April till now, they have actually increased by around 15 percentage points. India's key fault line remains that we as a net importer have a higher impact due to increase in oil prices. A 10 percentage point increase in oil prices leads to a 0.3% increase in the fiscal deficit and 0.4% increase in the current account deficit. While the current account deficit at around 2.5 percentage point levels is fairly manageable given the FDI and the FPI inflows in the country, we need to monitor the same of how oil prices pan out incrementally. Other macro indicators indicate that growth is on a firm wicket. Q4 FY18 GDP growth was at 7.7%, which was higher than estimate, largely driven by investment and government expenditure. Consumption as well as exports was rather weak versus expectation, but we expect that in F19 they should also contribute to the overall growth. Street estimates that F19 GDP growth would be around 7.5% versus 6.7% in F18, which looks fairly realistic as of now. High frequency indicators indicate that economy is gaining momentum. Consumption parameters like two-wheeler sales, passenger vehicle sales, air passengers flown, petrol consumption all point to a robust outlook. Investment parameters like cargo growth, MNHCV sales, steel demand or core index growth all indicate early signs of recovery for the capex outlook. However, the inflation dynamics is not that positive. Headline CPI inflation has been above 4% mark that RBI set for itself consistently for the last few months, because of which RBI in its recent policy meeting has actually raised interest rates by 25 basis points. Importantly, the inflation forecast for the full year F19 has now been increased to 4.7% versus an earlier expectation of cooling down in second half of F19 to a rate of around 4.4%. While the macro is moderating, when we look at the micro, companies are reporting improving sales traction. Data from the latest quarterly numbers of over 2,000 companies indicate that the sales traction has improved to 13% YOY versus 9% kind of a growth reported in the December quarter. More importantly, our recent interactions with the companies in various conferences indicate that 3 out of 4 companies are witnessing improving demand environment, which should translate into better profitability as we move ahead. Though F18 has been a single-digit earnings growth, we expect F19 to be marked better with a double-digit kind of an earnings growth. In sectors, we continue to like consumer discretionary sectors, especially rural consumption, as the aggregate demand is improving. Private sector banks, because of the fact that the market share gain theory continues. Infrastructure companies, largely based on robust government orders, and metals, since the global growth continues to be strong. Among the global developments, US President Trump continues his flip-flop on various issues, right from meeting the North Korean leader to imposing trade tariffs on metal imports from earlier friendly nations to its stand on dealing with trade balances with China. There was some political confusion in Italy with a scare that it will eventually exit EU, but that has got better over the last few days. In case of emerging markets, some of the countries have seen severe stress. Argentina and Turkey has seen the currency fall by double digits over the last 1 month due to higher external debt and high current account deficit. Considering the EM stress, INR has done relatively well. FII flows were negative with $1.5 billion of outflows in equity and $2.6 billion of outflows in debt. DIIs continue to have positive flows for the 14th consecutive month with flows over $2 billion in May. So what is the equity market outlook? When you look at BSE 500 companies, you see that 50% of this BSE 500 stocks, that is 250 stocks, have corrected by more than 25% in the recent correction, of which 90% fall in the small and mid cap category. Nifty as an index has largely been flat during the month of May, whereas small and mid caps as an index has corrected by 6% during this time frame. We as investors always look at good earnings visibility with high ROCs and try to find companies at reasonable valuation. While for the whole of last year we have maintained a large cap bias in the overall portfolio allocation, we are getting constructive on the mid cap space. We think it would be prudent for investors to allocate 20% of their overall funds towards mid caps, given that they are now quoting at reasonable valuations and many of these companies have good earnings growth given that economic momentum is picking up. Besides, we have a whole host of funds across categories based on SEBI categorization that you may want to choose from. Coming to the debt market view, it is pertinent to note that repo rate at 6.25% is 150 basis points above the expected headline inflation number of 4.7% in the coming 12 months. And Street is currently pricing in at least 2 rate hikes. The yields are at attractive levels and we would recommend investors to look at credit and other accrual funds that aim to provide consistent returns with low volatility. Thank you and happy investing.